Good morning, good afternoon, good evening, depending on where and when you will be seeing this video. This is Mr. Kimbode, the King of Wales, the lead analyst at Potential Miners International, a research platform that is dedicated to looking at different aspects of life from a research angle and announcing opportunities at individual level, corporate level, and even at government level. Today, one of the products or one of the areas that we have focused our research on over the last 6, 7 years is the forex market. And of course, we have been committed to coming here every week discussing the forex market from a global perspective. So today, I welcome you to the uh, King of Waves or global macro trading with the King of Waves. And we are going to be looking at the market today, starting from the fundamental analysis. We'll move to the sentiment analysis, and we'll move to the technical analysis. And the essence of this weekly market overview from the global perspective is so that we can educate uh, traders on what assets are they to focus on for the week. This is because a lot of traders, they don't have that holistic perspective of viewing the market to know what exactly am I to trade. They just get to the chart, pick a random asset or currency pair, and they begin to trade. And we notice that this has been the reason for a lot of traders being frustrated in the market. And we want to contribute our quota to the community by coming on board, looking at the different assets and different currency pairs, having analyzed the market from a global perspective, from the view of the fundamentals, the sentiment, and of course, the technical, the direction of the big players. So today we want to quickly go into our technical analysis, our fundamental analysis, I beg your pardon. And when we say fundamental analysis, what we mean actually is to look at the summary of economic indicators of the 8 major currencies, which which means we are looking at the summary of the economic interplays of the 8 major economies that we focus on in the forex market. I mean the likes of Australia, Great Britain, United States, Canada, New Zealand, and then of course the Europe zone, the Eurozone, Japan, and Switzerland. So we want to be looking at what is the summary of the economic interplay of each of these economies. And what we mean by summary is to look at the standpoint of the interest rate as of today, 21st of April 2026, and to now overview, do we have any expectation of any news data that might change the standpoint of the interest rate or the trajectory of the interest rate looking forward, so that we can put that to heart? The reason why we sum our fundamental analysis, especially when it comes to economic indicator, to the standpoint and the future trajectory of interest rate, is because every other economic indicators, they contribute or dovetail to the interest rate decision. In essence, forex market has been acclaimed, and that's just the truth, as a game of interest rate, which means whatever data is being released, whether it's pertaining to the gross domestic product, is pertaining to the level of unemployment or employment change, whether it's pertaining to retail sales, whether it's pertaining to inflation, any other economic data. What those data sets stand to do is to stand as a reference point for the policymakers. And the policymakers, their focus is on the interest rate. They want to use this interest rate to regulate the performance of the economy when it comes to stability of the economy in terms of the inflation rate. And of course, when it comes to the level of employment, they want to see, are we really engaging our resources to the fullest? So that's when they begin to look at what is the level of the output, what is the level of the employment in the economy, and what is happening to the inflation by and large vis-a-vis the target inflation rate for the economy. And of course, it doesn't mean that when we say we focus on the interest rate per se, you cannot follow other economic indicators. What we are just saying is that for you not to get yourself confused, the most important economic indicator when it comes to fundamental analysis for currencies in the forex market is to look at the interest rate. This is because investors take note of this. This this is a particular indicator that the big players they focus on, and if they want to make their decision, especially on the intermediate and the long term, they want to look at the interest rate differential or interest rate divergence. So today, like our usual practice, we want to start with what is the position of the interest rate for Australian dollar, just like we used to do. So as of today, 21st of April 2026, Australian dollar maintains interest rate of 4.10%, the highest in the list of the 8 major currencies, followed by Great British Pound and the United States dollars with interest rate of 3.75% respectively. And the next on the hierarchy is the Canadian dollar and the New Zealand dollar that maintain interest rate of 2.25%, followed by Euro with 2.15%, Japanese yen with 0.75%, and lastly, Swiss franc maintain interest rate of 0.00%. Now, this is showing that if you want to look at the matchmaking or pairing of currencies, you want to look at the interest, the currency with a very high interest rate. You want to look for a way to pair it with a currency with a very low interest rate. And given that the sentiment is in favor of that particular direction, you can now expect a very smooth trend in the market. The reason why this is important is because investors engage in carry trade. They want to get funds from economies with a very low interest rate, and they move it into assets in economies with a very high interest rate, and that's what we call carry trade. And when there is a massive flow of capital like that, if no sentiment is altering that particular flow, you are going to see a very clear trend. And of course, if you have been trading forex, you will agree with me that the trend will always be your friend, and it's always advisable to trade alongside the trend. So today, what we have for on the standpoint of the interest rate is what we have just overviewed. What we do next is to look at the week and to see what are we expecting in terms of change in data set. So let's see the economic calendar, and I just want to refresh my page so that we can have the latest update of what we are looking for the week. So today is Tuesday, 21st of April 2026, and we have had quite a number of highly impactful news releases for today, including the claimant count change for GBP. We have the core retail sales month on month for the United States dollars. We have the retail sales month on month, and of course we have a soft data that somebody Fed chairman designate Wash testifies. And of course, as much as those data set look impactful when it comes to the gauge of their impact, we are not expected to be trading them directly as if we are just trading the news. We just want to follow to know If you will now see a very massive or significant change in the trajectory of the market, we can trace the change to the news that has been released, and we can now follow it to say what will be the effect of this on the I beg your pardon, on the interest rate looking forward, because that is where we really need to focus on. So for tomorrow, we are expecting another news release that is important. That's the inflation news release in terms of the CPI year on year. This is very central. And of course, from what we are expecting for GBP, the interest rate, the inflation rate should increase, has been forecasted to increase from 3.0 to 3.3. And of course, we are expecting that if this happens, it means that there is likelihood for GBP to gain a bit of strength, because when the inflation rate is on the high or is on the increase, especially when it's moving away from the usual 2% target, that is going to make the policy makers, the interest rate decision makers, to hike the interest rate. And of course, that is good for the movement of the currency upward. And of course, let's look at what we have for Thursday. For Thursday, we have important news like the manufacturing PMI, and of course, for euro and for GBP, and including the manufacturing and the service PMI. These are survey data which is also very important when it comes to the policy decision of the decision makers. And however, just like I've said, you just want to follow this important news release so that you can begin to connect the mechanism of how the decision makers come about the conclusion of their decision when the date for that particular decision comes in terms of the interest rate. So having said all of this, the next analysis we do is to look at the sentiment of the global market, specifically in terms of the forex market. We want to see what is the sentiment of the market on the global level. And to do that, we have five major indices that we use to gauge the sentiment of the market, starting from the S&P 500. And of course, if you have been following us, you will notice, you must have heard me say that if you want to see the direction of the index, as what is the importance or the important time frame, you want to consider the daily. So if you are looking at the S&P 500 index, you want to consider the daily. If you have a predominantly bullish structure on the daily and the index is trading above this directional gauge, this cloud, you can be rest assured that that is symbolizing or is signaling that the investors, they are optimistic about the global market, and they are now pushing their capital, their funds, into area of best yield. And that's when it comes to S&P 500. But because we want our analysis to be robust, and we don't just want to look at one index and conclude about the sentiment of the global market, we also look at other indices, and that include the Dow Jones Industrial Average. And just like we saw on the S&P 500, the Dow Jones Industrial Average is also showing a predominantly bullish structure trading above the cloud, and that is also signaling a level of optimism in the market, followed by Nasdaq Composite Index. This is the third gauge that we usually look into, especially as related to the stock market on the global level. So we look at the Nasdaq Composite Index, and obviously this is also giving us a very bullish structure on the daily chart now, which also signal optimism in the market. So we now want to see if there is a level of optimism in the market, if there's a level of confidence in the market, in the mind of an average investor, to the tune that they are pumping their money in the stock market predominantly this season. And what we want to look at, what is the level of this stability? And of course, if there is a fear, we still want to gauge what is the level of the fear. And that is what the VIX volatility index of the S&P 500 is measuring. Usually, the threshold for this fixed index is 20. If the index is trading below 20, is telling us that the level of stability in the market is a bit high. And when the index is trading above 20, it's signaling that there is a level of fear in the market. And immediately you see the index trading pretty above 20 into 30 into 40, it shows or signals a level of panic in the market. But as of today, what we have today is 21st of April 2026. What we have for the VIX is 19.08, which is below 20. And obviously, that is also corroborating what we have for the three stock market indices that we have considered. So in all, based on these four indices, we are now beginning to see that there's a level of risk on in the market. The investors, they are not panicking. There is no fear as of now. And of course, that is reflected in the stock market indices. And it's not far-fetched because there is currently, we have a 2 weeks ceasefire between United States and Iran, and we want to believe that this is why we are having a level of stability. Whatever will happen that can shift the trajectory of the sentiment of the market will probably happen after that 2 weeks of ceasefire elapses. And that is why we want to really pay close attention to what is happening currently in the forex market, because anybody can just come up with a tweet, and that tweet can disrupt the market because there is still a tone of war between countries, the big players in the world. And lastly, on the sentiment analysis, we want to look at the position of the dollar. Last week, we said that we are expecting that, given the current structure of dollar, we expect that on the overall, there's going to be a dollar aversion tone on the overall for the week. And like we have it, a dollar decision is still not balanced yet, but predominantly we can see a bearish structure on the daily. And because this particular structure is at the middle of, like, is like we are within the threshold of transition. That is why you are not seeing massive move in the forex market. Whatever you are trading in the forex market since last week, you can agree with me that you have not seen any major move in the market. And that is because an average investor is looking at, if there is a 2 week ceasefire, we don't know what will happen after the 2 weeks. So everybody wants to hedge on the side of caution, to say that even if I'm going to pump my money massively into the market, let me wait for what the decision will be after the 2 weeks agreement of ceasefire. You know that Donald Trump, as a person, can come up any time of the day, especially after the 2 weeks agreement, and announce another thing which can disrupt the market. So you will see that the position of dollar is not clear yet, but predominantly we are noticing a tone of dollar aversion in the market. Of course, this can change anytime soon, depending on what comes after the 2 week ceasefire. But as for today, 21st of April 2026, our conclusion is that we have a tone of dollar aversion, which means that to a greater level, investors, they are dumping dollar. Investors, they are on the side of dollar dumping. Now, to cap our sentiment analysis, the summary of the whole analysis, having considered all our indices, is that we have risk on dollar aversion. We have risk on dollar aversion. This is very important. In fact, if you have not listen to my video on the sentiment overview of the market, you might need to search for it on this particular channel. I discuss what happened during each of the sentiment overview. Like I've said, we have four major sentiment overview of the market. Is either we have risk on or we have risk off. Then we now have a sub overview which can be risk on dollar aversion or risk off dollar aversion, which means we have four type of risk sentiment in the market on the global level. So whatever is happening at the moment is what will determine where the capital will be flowing into globally. So for today, 21st of April 2026, we have risk on dollar aversion. And it means that when you pick any currency pair, you are expected to analyze it that if the tone of the market globally is risk on dollar aversion, where is capital flowing into? Will it be in favor of the quote currency or the base currency, depending on the currency pair that you have picked? But to put this into perspective, we are going to pick one or two assets, and we are going to analyze it together as a family, so that you will see what I'm talking about. So we want to start with gold. Our expectation for gold has been that, I've said it, that predominantly gold is on a bi-directional bias. Gold is on the bi-directional bias based on our directional bias gauge. And once we have a directional bias defined, we will never trade against that particular bias. So it means at Potential Miners International, we are going to be looking for a buy trade predominantly on gold. Nothing will make us buy on gold for now. Why? Because the directional bias is still a buy. And of course, when you now compare or analyze that vis-a-vis our sentiment overview, what that means is that when there is risk on dollar aversion, because gold is quoted against dollars, if the aversion tone increases, you are going to see a pump on gold. You are going to see a pump on gold, which means that expectedly gold is going to move to the upside. All other things held constant. So at Potential Miners International, what we are looking out for on gold is going to be a buy trade. Of course, we have our rules of engagement, the conditions that must be met before we can take a position, even when our directional bias has been defined. So, but on the overall, in case you are listening to me and you are wondering what can you do on gold for this week, for gold we are expecting a buy on gold. So if you want to trade professionally from the global standpoint, from the global macro point of view, you want to stay and be looking out for a buy on gold. It doesn't mean that you might not see a short sell on gold, or maybe the market just moved to the downside and you'll be thinking, what is now going on? What we are saying is that predominantly what we are expecting for gold is a buy, which means even if we see a signal for a sell on gold, we are not going to take it. So that's, by the way, on gold. So let's move to BTC. For BTC, the directional bias is a sell. The directional bias is a sell, and of course, the reason why this bias might not be looking like it for now is because currently the tone of the market is risk on dollar aversion. What that means for BTC is that usually when there is risk on, investors want to pump their money into BTC. And of course, the reverse happens, that when there is a risk of, BTC will be selling, because investors will be pulling their capital away from BTC. Now, because BTC is now quoted against the dollars, when you have dollar aversion, what that means is that fund is moving predominantly away from dollar. So despite the fact that we have directional bias for BTC to be a sell. For now, momentarily, as long as dollar maintains an aversion tone, you might see a short buy on BTC. However, at Potential Miners International, we are only positioning for a sell on BTC. I've said this over the last 2 to 3 weeks that we're expecting BTC to fall to around 52,000. That's what we are expecting for BTC. And of course, if that does not happen and BTC start to buy, we expect BTC to buy up and buy to break the structure like this, to probably break uh, above the cloud. Once BTC breaks above the cloud and close around 95,000, we can now begin to look for a buy on BTC. But as for now, we will not take any buy position on BTC. Why? Because the directional bias that we are looking for, which signal the position of the big players in the market. And of course, when we say position of the big players, we mean the trend of the market. So currently the trend of BTC is a sell, and we don't want to trade against the trend. And that is why we will not be looking for any other position on BTC apart from a sell position. Having said that, let me see if we can do one more asset before we call it a day today. I want to believe that you are still following us. Last week I discussed GBP JPY, and I said that we are expecting a pretty much buy on GBP JPY, and that is still standing. Why? Because the directional bias for GBP JPY is a buy. And of course, from the fundamental standpoint, the interest rate for GBP still remains 3.75%. When you compare that to the interest rate of JPY, you will notice that JPY maintains 0.75%. There is a very wide interest rate divergence when you look at these two currencies. So when you pair GBP with JPY, you expect that there's going to be a massive move of capital into GBP away from JPY. Now, when you now consider the risk sentiment of the market, just like we have analyzed at the beginning of this video, we concluded that the risk sentiment is risk on dollar aversion. What that means is that the dollar aversion capital will be flowing away from dollar, and once capital flow away from dollar, we have 2 or 3 currencies that we accept or attract that the capital flowing away from dollar. We call them dollar aversion currencies, and that includes GBP, that includes euro, and that includes CHF. So these 3 currencies, anytime you notice a sell-off on dollar, which means investors, they are losing confidence in dollar, the capital flowing away from dollar is expected to flow into any of these 3, GBP, euro, and CHF. And that is why, be that as it may, when we look at the fundamental standpoint, we look at the sentiment standpoint and the technical standpoint, our expectation on GBP JPY is a buy. We are not going to be taking any other position on GBP JPY other than to buy. However, we have been expecting GBP JPY to trade into our discount zone so that we can now begin to look for positions. So we expect GBP JPY to trade down here. This was what we were expecting, and of course that still stands. Since last week, we have not been taking any trade because conditions were not met, and that's how to trade. If there is no trade, if the conditions are not met, you don't need to force a trade. In fact, if you will notice that any trade that you force, most of the time, you will still end up a loss. And it's not as if you will not lose eventually in the market, but there is a way you lose that you will still be confident that you are in tune with your trading framework. And that is very central. You can even have 3 losses in a row, even after you have followed your trading system. However, those losses will not affect your confidence in your trading system, and that is very important. The reason why a lot of traders they are just bent on entering the market without having to follow their trading system is because most of the traders they are trading peanuts. I want you to imagine that you are trading with 10 million US dollars, and each trade you enter you are going to enter it with 500,000 US dollars. One trade you are going to risk 500,000 US dollars. Will you just be entering on 15 minutes and be buying and be selling because a candlestick is moving up and down? No, but because a lot of traders they come into the market thinking they can flip, their $50, their $500, their $1,000, and flip it into $2 million. All of a sudden, that's why a lot of people they are just trading the way they trade. At Potential Miners International, we have set of rules, and we only enter trade once those rules are met. If those rules are not met, even if it will take us 3 weeks, we are staying off the market. Of course, we'll be looking at the market because it's a platform that we have been committed to analyzing the market, but that will not make us take irrational decisions to enter trades in the market when our conditions have not been met. And this is how you can trade in the forex market and make consistent money and stay for the long haul in the market without getting your fingers burnt. You look at the market from the professional standpoint, you have some set of rules that define your trading system, then you follow those rules as if you are a robot. Period. That's how you trade. And if you want to be a part of our trading community, you can join our Telegram channel. The link will be part of the description of this video. You want to see when we call trade, when we do, you want to pick the trade with us. And of course, we want to help you to grow the mindset of a professional forex trader. And this is how we do, and this is how we roll at Potential Miners International. I want to encourage you to subscribe to this channel and share this video if you know any forex trader that is struggling at the moment. Until I see you in the next video, I remain Mr. Akimbode, the King of Waves. Thanks for listening. God bless you.